So this is a chart from Matt Watson. He's an analyst that does all the metals across the board based to exotics like iridium, which I know almost nothing about. So this is a chart showing silver demand, what he calls the low case. And the red line is all silver production, which means the black line, which is the mining. And the red line is mining plus recycling. And what you see from 2024 onward is that basically we're in a deficit situation based on industrial demand alone, and that we've been in a deficit for the last 4 years or thereabouts.
Well, in the futures, we watch the front month contract. Now, I know spot is above the front month contract, and it got to 51 and dropped back under 50 slightly, so it made new highs. Futures did not. They stopped at 49.768, a couple cents below $50. So some guy said, I'm going to sell the nearby future just below 50 and risk a nickel. Okay, make a dime. Okay, well, they're getting a sell-off here, fine. Okay, I think it's idiot selling. Our assessment technically is that silver is about to make a quantum leap to a new reality.
First of all, I want to agree with Michael. I think we're going to get through 50, and I think we're going to look at it in the dust at some point. But to be consistent, I have said over and over, as you know, that I thought we might stall out at 50 because it's such a psychological barrier. And we saw one increase in margin requirements. And I noted that. I think I retweeted it to Craig, if I remember correctly. And this is what they do. I mean, they keep increasing margin requirements until you got to put up basically the cash cost for the commodity, and then you see the market fall off. We're getting that direction. I'm not surprised. I got let's say, I won't say angry, but a agitated member this morning. First thing I get up, I haven't even had my coffee. What the hell's wrong, David? Silver is at 51 and every one of my stocks is down. What I said was, look, normally the shares lead the metal. And this is the pros taking profits in the shares and selling it off. And it's like they get the memo ahead of everybody else. So I don't want to put on the foil hat too much. There are times where these markets do what they do because of the setup. And this is one of those moments. And I do want to show a chart later on, Elijah, but I just want to hand it over to my colleagues and hear them. And I'm not making this an I'm a right and, whatever, because I want to see a couple more days of trading, but I'm not shocked that we hit that magic number and all of a sudden the big sell-off. So I'll leave it at that. Thank you.
Well, in the futures, we watch the front month contract. Now, I know spot is above the front month contract, and it got to 51 and dropped back under 50 slightly, so it made new highs. Futures did not. They stopped at 49.768, a couple cents below $50. So some guy said, I'm going to sell the nearby future just below 50 and risk a nickel. Okay, make a dime. Okay, well, they're getting a sell-off here, fine. Okay, I think it's idiot selling. Our assessment technically is that silver is about to make a quantum leap to a new reality.
In precious metals investing, equities tied to mining often lead the motion, not lag it. If miners' shares drop before the metals decline, that suggests insiders or institutional players are stepping out early. That pattern occurred recently. While silver flirted with highs, many mining stocks sold off first. That divergence can signal a flush ahead. In this chapter, we examine how traders read equity signals as early warning signs, how they get the memo early, and why these dynamics often foreshadow larger price moves in the physical metal itself.
It's not heading a bull trend. It's in a total shift phase in its price zone that it's lived in for 50 years. 50 highs, basically 20 is sort of a low, and it just lived there forever. Go to the Federal Reserve of St. Louis, Fred, and you can punch up charts like lead or zinc and go back in price history. And they'll have a monthly close-only chart going back to the 1990s anyway. And you'll see that they lived in a zone for quite a few, decade and a half or so, both those base metals. And in 2006, very late that year, silver and gold were already in a bull trend at that point. These metals took off and tripled in value, base metals. And since then, they've come back down, but they've never come back down into that prior zone of reality. They live in a new zone of reality that is double or more on average for the last 10, 15 years of what it used to be back in the 1990s to 2000. Well, silver's still in that first range, okay, where it was from the 1979-80 high, the 2011 high. Gold's above the 2011 high, copper's above the 2011 high, and silver's still contained here? Give me a break, okay? We know the fundamentals. I don't try to keep up with them too intimately because that's not what we do. But the technicals argue to us that we're about to blast out of this range and not just have another nice leg up, but move into a price zone of new reality. I'm betting it's well over 100. It may be between 100 and 200. And I think a lot of that's going to occur in a handful of months, 5 to 6 months. We're waiting on one trigger. That's a spread relationship between gold and silver. And we run momentum studies of it as well. Now, everybody looks at the ratio, the 80, 70 to 1 type thing. We do it a different way. We divide silver to gold, express it as a percent.
We aren't merely in a bull leg upward. The price of silver has been trapped in a range for decades, a narrow band that's become normative. But technicals now hint at a regime change, a move to a new baseline. Rather than rising from 20 to 50 over time, silver could break into a zone it's never fully inhabited. If it leaves its old range for good, history suggests the move could be dramatic. Some forecasts project well over $100. In this chapter, we plot the case for a structural transition and examine parallels in base metals and historical cycles.
And right now, silver is about 1.2% of the price of an ounce of gold. That's extremely low going back 50 years. It's been over 2% in 21 of the past 50 years. Silver has reached 2% of the price of gold. And some of those weren't even bull market years. Okay, so we're very submerged, but there is a very clear structure on the spread charts. When you plot the spread chart, silver versus gold, there is a pending triple top breakout at 1.31%. So we're not far below there. When we cross that level, the same thing happened to its spread versus gold in 1979 and in the fall of 2010, just before silver went totally vertical. It went from like 20-something bucks to 50. Boom! All in a handful of months. The spread was the tell. And we're watching that. We think it's going to break through. And our momentum of the spread suggests that even a lower level than that 1.31%, which is a prior double top, will break out before that. And when we do, when that spread breaks out, I'm putting the seatbelt on. I think silver is the place to be for the next 2 quarters. And the move could be enormous. And you look back and say, oh, now I understand why. Supply demand's been tight, et cetera, et cetera. Market has been an irrational level for too long compared to other metals, for example, that have done the same thing, had a tantrum and moved to a new reality. Anyway, that's my major comment.
So this is a chart from Matt Watson. He's an analyst that does all the metals across the board based to exotics like iridium, which I know almost nothing about. So this is a chart showing silver demand, what he calls the low case. And the red line is all silver production, which means the black line, which is the mining. And the red line is mining plus recycling. And what you see from 2024 onward is that basically we're in a deficit situation based on industrial demand alone, and that we've been in a deficit for the last 4 years or thereabouts.
A pivotal metric lies beneath the surface: how silver trades relative to gold. Many use the gold-silver ratio, e.g. 80 to 1, 100 to 1, but here we divide silver by gold, expressing silver as a percentage of gold. Currently, that ratio is exceptionally low, around 1.2%, historically beneath its normal range. Charts show a potential triple-top breakout at 1.31%. When that level is breached, markets in previous cycles witnessed explosive silver runs. That spread metric, more so than absolute price, may be the true ignition point. This chapter unpacks how the spread functions as a latent lever in the market.
Now, That's what Jim Dines used to call a natural corner. We've all heard about, ad nauseum, the hunts try to corner the market and all that. Well, what Dines said is there'll be a time where the market forces for industrial use only will corner the market. In other words, we won't be able to mine and recycle enough to meet the demand. Well, that's what this chart shows. Now, where I disagree with Matt honorably is the silver or gray bar on there shows investment demand. That investment demand is roughly 200 million ounces consistently from 2025 to 2050 for the next 25 years. Well, no one knows the future, but I contend that as we move into this paradigm, which is one of my main themes from day one when I learned about honest money, is that you can't print your way out of this mess, which means more and more people are going to be seeking real truth, which means real money. So those gray bars, you could double and triple them. And not to be too nitpicky, but the line at 2020 shows 200 million. That is incorrect. It should be up here where, if you can see my cursor, at about 1.25. Because in that year alone, the demand for silver in quote unquote physical terms was 320 million by the ETPs and the normal 200 million by retail, for like 520 million ounces in that 1 year on investment demand. So if we can do that in 2020, we can do it in 2025. So I think this situation is, Michael and Craig have said, and many of us, that we're getting into a new paradigm. I don't like to use that lightly, and I think Michael said it best. I mean, we're in a situation where reality is going to shine through on all the naysayers like they can't believe it. I mean, we get through 60, 70, people are going to be doing the one-handed salute going, oh, I hated Morgan, or he's an idiot, and oh my God, look what's happening now. I don't have too many detractors on X right now. I'll put it there. I'll give it back to you. I'll quit sharing the screen. But and that's the low case, by the way. If things go higher for AI or EVs or what have you, it'd be beyond that. So I'll just leave it there. Thank you for letting me share.
Beyond technicals, the physical market paints a powerful narrative. Production plus recycling currently struggle to satisfy industrial demand. Analysts chart supply curves against red demand lines. From 2024 onward, deficits emerge. Some believe the investment demand leg will grow much larger than conventionally assumed, especially as awareness of monetary value increases. If speculative demand doubles or triples, the stress is magnified. In this chapter, we explore how a natural corner can form when industrial consumption overwhelms supply, forcing the price higher.
That reality's been there for a while. We know that. Recent years where the supply demand is the way it is and demand increasing, supply is not, et cetera. And yet price hasn't responded in a real way. I mean, you think about dollar terms also. 1980, $50. In real dollar terms, where would it put us now? It's probably 250, okay? In the decay in the value of the US dollar, not relative to other currencies, but in real buying power. Even over since 2011, money supplies increased like 150%. Okay, has silver increased that much above the 2011 high? No. Okay, so there's all kinds of realities out there that we know exist. We scratch our heads and say, this is ridiculous. Okay, we do anyway. And we know when it changes, it could change in a way that is, well, we've seen it in many markets. We've been around long enough to see when a market gets overvalued for too long, it gets ridiculous. In hindsight, everybody calls it a bubble. Of course, when it was happening, nobody called it a bubble. Or a market gets suppressed for so long that people think, oh, that's a new reality. It's a piece of crap. We don't, who cares about silver anymore? And it suddenly says, I'm going to wake up. Markets make mistakes. Investors make mistakes in terms of allocation, proper pricing in relation to reality. These things happen. Markets aren't always rational. And I'm arguing that silver was irrational, especially for the last 10, 20 years, of not ever coming up above this base range high that virtually every metal in the world has done. And not silver? Oh, okay. What for?
If silver breaks free, it won't just climb, it may leap. Scenario analysis sketches a base case between $100 and $200 per ounce over the next months or years, but it's not guaranteed. Recent forecasts from Wall Street banks suggest more modest gains. For instance, some optimistic estimates place silver near $65 by 2026. Meanwhile, cautionary voices warn silver lacks institutional support like gold. The final chapter frames plausible pathways, a measured breakout, an overshoot followed by correction, or continued consolidation. This is not a replay of past bull runs, it's a redefinition of how silver is priced.
And now it's moving with gold now because it's a monetary metal, but when silver engages on the fundamentals, like the graph we just saw, it'll have its own life. And I think it's going to move to a new reality. And again, if you do a dollar conversion, $200 is not irrational whatsoever. And sometimes when markets are too irrational one way, when they correct the other way, they overcorrect. Okay, you go way beyond what the new reality might be in silver. Maybe silver's going to live in $100 to $200 range for the next 10, 20 years. But it might reach 200 and fall back to 150. You'd get my point. And there's a new reality. The technicals are arguing for that, especially the long-term momentum technicals and the spread relationship to gold. Argues that silver, just to go back to its normal reality, let's say 2% of the price of an ounce of gold, which it's been 21 of the last 50 years. You've seen it at that level. In bull markets, silver spread to gold goes above 3%. In 1980, it went to 6.5%, the price of gold. But let's say it just goes to 2%. Well, what's 2% of $4,000 gold? Okay? What if gold goes, and we've been arguing this, and does what it did twice before? It had bull markets in the last 50 years, both of which were 8-fold gains, bear low to bull high, under circumstances that are far less dramatic and earth-shaking than what we have building out there now. If gold did it again a third time, had another 8-fold move, we'd be 8,500. Well, what's 2% of that? Okay, you get my point. Silver's going to move into a new reality. This selling at 50, I love it. It tells me the idiots are still there. They stick a nickel in front of a freight train, and they got, quote, overbought situation on a short-term basis, but they don't see the larger context. And it wouldn't shock me that when we finally go through 50, we have a situation where we close one, we're talking futures now, December futures. They're 47 something right now. They were up to just below 50 today. When they go through 50, it wouldn't shock me, and I'm not predicting, I'm just saying this would be justice. You close one day out at 49, next morning you open $3 higher, limit up or something, because force majeure, something going on, one of the fundamentals kick into gear, and suddenly you don't give these guys a chance to stop out of their short position. They put on at 50. You nail them to the wall and see if they can get out. And it wouldn't shock me that that's the way it happens. So I love seeing the selling at 50 because it tells me the idiots are still there.